Okay. So, good evening, Amma. So, my name is Sravan Kumar, and I'm a cost accountant, and I'm an All India ranker in CMA final, and I'm here to teach the paper 18. So, indirect tax laws. Indirect tax laws. So, first, before going to the paper, so we will discuss some basic topics relating to the taxation. So, first of all, what is meant by tax? So generally, tax is a nothing but it is a burden imposed by the government on the public for providing developmental activities. So generally, government required to provide number of developmental activities to the public in terms of what hospitality and security and defense and infrastructure like roads, railways, and so planes, airways, so etc. These all activities required to be provided by the government. But for providing these all activities, government need fund, government require revenue. But the government is not a business entity. If it is a business entity, then it did the trading of the good or provide the services and then the money and that amount is utilized, but it is not a business entity. Then how to generate the fund? The fund is generated from the public for providing what developmental activities, and that is technically called as what tax. So tax is nothing but it is a compulsory burden, compulsory burden imposed by the government on the public for providing developmental activities. So this is what is meant by tax. So generally taxes are classified into the two types. One is what direct tax and another one is what indirect tax. So the first one is what direct tax, another one is what indirect tax. So why these, how the taxes are classified? And based on what factor taxes are classified into the two types, direct and indirect. So generally there are two factors are there. One is impact of the tax and another one is incidence of the tax. First one is what impact and another one is what incidence of the tax. So what is meant by impact of the tax? Impact of the tax is nothing but the effect of the tax on the person on whom the tax imposed first time is said to be about impact of the tax. So the effect of the tax on the person on whom the tax is imposed first time is said to be impact. So that is nothing but, for example, Mr. A earned the income of around 20 lakhs during the year. So once the income earned by the party, then central government levy the one tax on that person, that is called as what income tax. So the first time the tax is levied by the government on whom Mr. A, the effect on that person is called as what impact. Is called as what impact. For example, coming to this another example, here coming to the trade cycle, if you observe, manufacturer and manufacturer produce the product, he sell the product to the distributor, distributor sell the product to the wholesaler, wholesaler sell the product to the retailer, and the retailer sell the product to its ultimate consumer. Other than the product produced by the manufacturer, then central government impose the tax on this person. On this person. So the effect on this person is said to be about impact, because first time tax imposed by the government on this person, effect on that person is said to be about impact of the tax. But the question is whether the tax burden to pay is bear by the party or shifted to the another person. So, coming to the first scenario, in this case, why the tax is imposed on Mr. A? Because he earned the income. So, once the income earned, that income utilized for what purpose? For his personal purpose or for his family purpose, like for payment of the tuition fee, for purchase of the clothes, or for purchase of the provisions, or for payment of the rent, or for entertainment for the family, or for tour, or for savings, so etc. These are all spent by the party for his family purpose. Nothing is transferred to the third party. So here, income completely utilized by the person, income completely utilized by the person. So he has to bear the tax burden. He has to bear the tax burden. But in this scenario, if you observe in the second example, manufacturer produce the product, but the product cannot be utilized by the party for his personal purpose. He transfer the product to the distributor, then distributor sell the product to the wholesaler, wholesaler sell the product to the retailer, then retailer sell the product to the ultimate consumer. Here, the product is transferred from one person to the another person until it reaches the ultimate consumer. Until it reaches the ultimate consumer. Here, the product is not produced by the party for his personal purpose. For his personal purpose. That's why here that party is not liable to bear the tax burden. The burden to pay the tax is shifted from one person to another person, like from manufacturer to distributor, distributor to wholesaler, wholesaler to retailer, and the retailer to the consumer. So the person who bear the tax burden on that party, whatever the impact is there, whatever the effect is there, that is called as incidence of the tax. So incidence of the tax is nothing but the effect on the person who ultimately bear the tax burden. The effect on the person who ultimately bear the tax burden. So in the first scenario, who bear the tax burden? Mr. A itself bear the tax burden because he utilized the income for his personal purpose. He does not transfer the income to the third party. So he bear the tax burden, that is called as what? Incidence of the tax. But in this scenario, if you observe, in this scenario, in the first case, in the first transaction, manufacturer pay the tax to the government, but that amount not bear by the party. He collected that amount from the distributor. So in this scenario, impact of the tax is on manufacturer and incidence of the tax is on distributor. Incidence of the tax is on distributor. And if you observe this scenario, so distributor sell the product to wholesaler. In this scenario, who pay the tax to the government? Distributor pay the tax. So he has impact and wholesaler has what? Incidence. And if you observe this scenario, here wholesaler has what? Impact and retailer has what? Incidence. If you observe this scenario, so retailer has what? Impact and the consumer has what? Incidence of the tax. But the consumer does not shift the burden to pay to the another party because he utilized the product for his personal purpose, right? He utilized the product for his personal purpose. So, impact of the tax is nothing but the effect on the person on whom the tax is levied first time is said to be an impact. And incidence of the tax is nothing but the effect on the person who ultimately bear the tax burden is said to be what? Incidence of the tax. Is said to be what? Incidence of the tax. So, if you observe the first scenario, here impact and incidence both are on same person. These are said to be what? Direct tax. The impact of the tax and the incidence of the tax both are on same person, then the tax is said to be what? Direct tax. If the impact of the tax is on one person and incidence of the tax is on another person, then the tax is said to be what? Indirect tax. Indirect tax. So clear. So taxes are classified into the two types. One is a direct tax, another one is what? Indirect tax. So coming to the direct tax, here impact and incidence of the tax are on same person. So here impact of the tax is on one person and incidence of the tax is on another person. Incidence of the tax is on another person. That is said to be a indirect tax. That is said to be a what? Indirect tax. The impact and the incidence both are on same person, then the tax is said to be a direct tax. If the impact of the tax is on one person and incidence of the tax is on another person, then the tax is said to be a what? Indirect tax. That is said to be a what? Indirect tax. Here, the person on whom impact of the tax is there is called as what? Taxpayer, because he pays the tax to the government. But incidence of the tax on whom is called as what? Taxpayer. Is called as what? Tax bearer. So in case of direct tax, if you observe, tax payer and tax bearer both are same. But coming to the indirect tax payer is one person and tax bearer is another person. Okay, so the coming to the second one, here tax payer is equal to what? Tax bearer. Here taxpayer is not equal to tax bearer. And as we said, the burden to pay the tax is shifted or not shifted? The burden to pay the tax is not shifted. So here the burden to pay the tax is shifted from one person to another person till it reaches the ultimate consumer. Like from the manufacturer to distributor, distributor to wholesaler, wholesaler to retailer, and the retailer to the ultimate consumer. In this way, burden to pay this tax is shifted from one person to another person until it reaches the ultimate consumer. The tax is said to be what? Indirect tax. Then coming to the direct tax, it is a progressive in the nature. And but coming to the indirect tax, it is a regressive. That is what? Regressive in the nature. So what is meant by progressive and what is meant by regressive in the nature? So here, if you observe, for example, Mr. A is there, Mr. A is there, he and the income of around 10 lakh, he pay the tax to the government, and Mr. B is there, he and the income of 50 lakh and he pay the tax to the government, and Mr. C and around 7 lakh, he pay the tax to the government. So if you observe, if the person earn the low income, he pay the low tax. If the person earn the high income, he pay the high tax. As the income increases, the payment of the tax increases. As the income decreases, the payment of the tax decreases. If there is no income, there is no tax. And simply said, here one point is considered while levying the tax, that we technically called as what? Ability to pay. Ability to pay. If the ability to pay the tax is considered, then the nature of the tax is said to be progressive in the nature. That is called as what? Progressive in the nature.
So in case of direct tax, the ability to pay the tax is considered. But coming to the indirect tax, for example, you go to the shop and purchase the shoes for around 2500, for rupees 2500, and then on that amount you need to pay the tax to the government. For example, at 10%, 250, the total amount you pay the tax to the government is nothing but 2750. For example, CM came to the shop and he purchased the same shoes for 2500. He is also required to pay the tax to the government. If, for example, PM came to the shop and purchased the respected shoes and he paid the around how much amount? 2750. And here, the earning of the person is not considered. Ability to pay the tax is not, ability to pay is not considered. Here, only the material item is nothing but whether the party purchased the good or not. If you purchase the product, you are liable to pay, irrespective of your income. And simply said, ability to pay is not considered. That is called as regressive in nature. That is called as what? Regressive. So in case of progressive in nature means what? If ability to pay is considered, the tax is said to be a direct tax. Simply said, we call it as progressive in nature. If the ability to pay is not considered, we call it as what? Regressive in nature. That is the nature of what? Indirect tax. That is the nature of what? Indirect tax. And another one is, so in case of direct tax, there is a direct pinch on the taxpayer. And in case of indirect tax, there is no direct pinch on the taxpayer. So what is meant by direct pinch, sir? For example, if I am the person and the income of around 25 lakhs per annum, I know how much amount I need to pay the tax to the government. For example, if you earn the income of around 50 lakh, then you know so how much tax paid to the government. Because every person who earn the income know the payment of the tax to the government. But coming to the, so for example, you go to the shop and you purchase the goods or you receive the services or you purchase any provisions or the chappals or anything required for your personal purpose, how many of you know whether they pay the tax or not? So even uneducated person go to the shop and purchase the shoes and they pay how much amount to, he said 2750 sir bill, then he paid the 2750. He don't know the classification of the bifurcation of the 2750. Out of the 2750, 2500 is the cost, 250 is the tax, you don't know. And how many of you verify the bifurcation of that price in the bill? So majority of the person pay the tax without knowing the fact that they pay the tax or not. That is called as a direct pinch. The direct pinch is not there in direct tax. But in case of direct tax, every person who earns the income knows the fact that they are liable to pay the tax to the government. Even uneducated person who earns the income, they know whether we pay the tax or not. Finally, they pay the tax or not is the secondary item. Majority of the person escape from the payment of the tax. But here the important point is there is a direct pinch. So every person who has the income knows the fact of payment of tax. But in case of indirect tax, every party pay the tax without knowing the fact that they pay the tax or not. That is called as what? Direct pinch. That is called as what? Direct pinch. So these are the differences between what? Direct tax and indirect tax. So simply direct tax is nothing but if the incidence and the impact of the tax both are on the same person is said to be a direct tax. If incidence of the tax is on one person and impact of the tax is on another person, then the tax is said to be a what? Indirect tax. So, but generally we may say in this way, the direct tax is nothing but tax paid by the person directly to the government without involving third party in between government and taxpayer. But coming to the indirect tax, customer does not pay the tax directly to the government. He pays the tax to the government through the retailer, wholesaler, distributor, manufacturer. So here, in between the taxpayer and government, some parties are involved. So here, in case of indirect tax, tax is not paid directly to the government. They pay the tax to the government through the third party. That's why we call it as what? Indirect tax. That's why we call it as what? Indirect tax. So the best example for direct tax,
Income tax. So indirect tax, GST and GST and customs duty. GST and customs duty. So these are the differences between direct and indirect tax. And along with that, some more features are there relating to the direct tax. Sorry, relating to the indirect tax. So features of indirect tax, as we discussed already. So impact is on one person and incidence of the tax is on another person. And the second one, the tax burden to pay the tax is shifted from one person to another person until it reaches the ultimate consumer. And the third one is it is a regressive in the nature. And the fourth one is it is one of the revenue source to the government. So these are all features. There is no direct pinch on the taxpayer. And along with that, another features are there like so it is levied on goods and services. That's why we call it as what? Commodity tax. Commodity tax. It is levied on what? Goods and services. And another one is it promotes welfare of the public by levying high rate of tax on sin products. So here we use the word sin product. So what is one of the sin product? Sin product is nothing but those goods which are harmful to the health of the human being. So like alcohol, tobacco products are there. So generally in case of alcohol, so state government impose a high rate of taxes on the respected product. So like around 75%, 60% and 100%, 125% in that way. They leave a high rate of taxes on the respected product. So just imagine if the rates of taxes are increased, then prices are increased. If the price is increased, then demand for the product is decreased. If the demand decrease, then consumption is decreased. If the consumption decrease, health of the human being is improved. So that is the basic thing. How the welfare of the public promoted by the government. It promotes the welfare of the public by levying high rate of taxes on the same product. But actually, what is the basic point? What is the reason for levying the respected high rate of taxes? The reason is nothing but sin products are nothing but habitual items. Habitual item. So in case of habitual items, if you purchase the, for example, if you purchase one wine bottle at 100 rupee, at 100 rupees there, then you purchase one bottle. If the price of the product increases, then you think that the price may be increased more and more, then you purchase more than one bottle at that time. So for example, the price increases to 250, then you purchase two bottles instead of one bottle. If the price increases to 300, you purchase more. So in case of habitual product, habitual item, as the prices increases, the party purchase more and more. Then government will get more revenue. So general point is nothing but so it exposes the reason is like it promotes the welfare of the public, but the back end is it generates the more revenue by imposing high rate of taxes on the same product. Okay, and another one is so it is levied on what goods and services. We call it as what commodity tax or consumption based taxation. Consumption based taxation. And another one is what it promotes the welfare of the public by levying high rate of tax on sale product, and it is inflationary in the nature. Inflationary is nothing but
the prices are increased. The price of the product is increased. So because if you levy the indirect tax, the price of the product is increased. The price of the product is increased. So these are the main features and differences between direct and indirect tax. So here, what is meant by tax and why the taxes are imposed in India and how many types of taxes are there? Nothing but what direct tax and indirect tax, and what are the features? So coming to the features, so it is a first of all it is the tax burden. So the burden to pay the tax is shifted from one person to another person until it reaches the ultimate consumer. Second one is, so here taxpayer and the tax bearer both are not same, means impact is on one person and incidence of the tax is on another person. And the third one is, it is regressive in the nature, means ability to pay the tax is not considered. So and means from the eye of indirect tax law, each and every person is same. So rich person and poor person same, government non-government is same. So each and every person is same. So common man and CM both are same. And coming to, there is no direct pinch on the taxpayer in case of indirect tax. So because majority of the persons pay the tax without knowing the fact whether they pay the tax or not. And another one is, so it is levied on goods and services. That's why we call it as what commodity or consumption based taxation. Another one is, it promotes the welfare of the public by imposing high rate of taxes on sin product. And the last one is, it is inflationary in the nature. Inflationary in the sense the price of the product is increases. The price of the product is increases. So these are the features of indirect tax. So here, coming to our topic, on 1/7 2017, so GST was introduced in India with a slogan, One Nation, One Tax. One Nation, One Tax. So then before 1/7/2017, which type of indirect taxes are there and why they are subsumed under the purview of GST, and which taxes are subsumed and which taxes are not subsumed under the purview of GST, we have to know. Okay. So before 1/7/2017, before 1/7/2017, so which taxes are there? Which taxes are there? So the first one is what? So excise duty, which is levied based on manufacturing of goods in India. And the second one is what? Service tax, which is levied based on provision of services in India. And the third one is what? CST, which is levied based on interstate trading of goods. So if the goods are traded in between the states, from one state to another state. And in case of customs duty, it is levied on imports and exports of the good, imports and exports of the good. So these are the four taxes which are levied by central government. Then coming to some state government levied taxes are there, because in India we have three-tier federal system. So central government imposes this tax, state government imposes this tax, even local government also imposes the tax. Local government also imposes the tax. Then coming to the state government levied taxes, the first one is what? VAT. So it is levied on what? Intrastate trading of the goods. Nothing but the goods are traded in between one place to another place within the state. Within the state. And another one is so luxury tax is there, and entertainment tax is there. Entertainment tax is there, and another one is so betting tax betting tax, and another one is octroi and purchase tax, entry and exit tax, etc. So in this way, a number of taxes are there levied by the government previously by showing different type of activities. Here we use the word activity. The activity based on which the tax liability is created by the government is said to be a what? Taxable event. Said to be a taxable event. Here, excise duty is imposed based on an activity called as manufacturing of the good. So, service tax is levied by showing one activity called as provision of services. And CST is levied based on one activity, nothing but interstate trade of the good. Custom duty is levied based on imports and exports. So the activity based on which the tax liability is created to by the government is said to be a what? Taxable event. That is said to be a taxable event. So first of all, why these all indirect taxes are subsumed? Which taxes are subsumed first? First of all, which taxes are subsumed here? Excise duty is subsumed under the purview of GST, except on one product, nothing but alcohol meant for human consumption. On alcohol meant for human consumption, even till the day we impose, so state government impose state excise duty. And service tax completely subsumed under the purview of GST and CST imposed. Remember one thing, CST is the only the tax which was levied by the central government but administered by state government. And VAT is subsumed, luxury tax subsumed, and another one is so entertainment tax is subsumed, betting tax is subsumed, and octroi is also subsumed under the purview of GST. Octroi is subsumed. And here, one tax is not subsumed, nothing but customs duty. Customs duty. So, if you know the custom duty, in case of custom duty, three taxes are there, like basic customs duty, cess, and countervailing duty, special additional duty, nothing but special countervailing duty is there. Special countervailing duty. So generally, so here, what is meant by countervailing duty and special countervailing duty? For example, if Mr. A manufacture the product in India. Mr. A manufacture the product in India, then he is liable to pay. For example, cost of the product is 10,000, then excise duty is levied by the government is 1,000. The total price of the product is 11,000. So, if the product is manufactured in India, which taxes are imposed? Excise duty means, so here the raw materials are imported from the outside India. Raw materials are imported from the outside India. On that raw material, we pay the customs duty to the government. Then after obtaining the raw material, those are assembled together and we produce the new product and we named it as manufacture. On that manufacturing activity, central government levy the tax is nothing but what? Excise duty. So, but for example, Mr. B is there, he import the product directly. He import the product directly from the outside India. Means this finished product directly purchased from the outside India. Then the product is available at what price? 10,000. Because the product is not manufactured in India, that's why our central government does not levy the excise duty. So here the product is available at what price? 10,000 only. Here domestic product is available in the market at 11,000 and imported product or foreign product is available at what price? 10,000. Then central government has the duty to secure what? Domestic product. So that's why to counterbalance the excise duty. So to counterbalance the excise duty which was levied in India, if similar products are manufactured in India, one tax is levied at the time of importation, that is called as what? what? Countervailing duty. Countervailing duty. So countervailing duty is nothing but it is the tax imposed by the government on importation of the product which is equal to the excise duty which was imposed. So if similar product was manufactured in India. So simply said, countervailing duty is nothing but what? Excise duty. And special countervailing duty is also, special additional duty is also imposed to counterbalance the local taxes levied by the government if similar product traded in India. No, if you purchase the product locally, you are liable to pay what? Either VAT or CST or octroi. These type of taxes are required to pay. If you import the product from the outside India, no need to pay that amount. Only custom duty is imposed. So to counterbalance the local taxes which was imposed when if the similar product are traded in India, then special countervailing duty is levied. It is equal to what? Either VAT or CST, octroi, etc. But at present, so these all are, so means excise duty, VAT, CST, these are all subsumed under what? GST. So, in case of customs duty, only two things, nothing but basic custom duty and cess. These are not subsumed under purview of GST. But which are subsumed under purview of GST? Countervailing duty and special countervailing duty or special additional duty. These are subsumed under the purview of what? GST. Okay. So, in case of imports and exports, here countervailing duty and special countervailing duty is subsumed. But coming to the basic custom duty, it is not subsumed. Coming to the basic custom duty, it is not subsumed under the purview of GST. Not subsumed under purview of GST. So this is about which taxes are subsumed under GST. Then before that, so which taxes are not subsumed under GST? So remember one thing, all indirect taxes are not subsumed. But majority of the indirect taxes are subsumed under purview of GST. Not the all indirect taxes. Some indirect taxes are there which are even levied after implementation of GST in India. So that is nothing but taxes not subsumed under GST. Taxes not subsumed under GST. The first one is state excise duty on alcohol meant for human consumption. State excise duty meant for alcohol. So state excise duty levied on alcohol meant for human consumption. Another one is entertainment tax levied by local authority. Entertainment tax levied by local authority are not subsumed, even those are imposed by local authority itself. And stamping duty and road taxes. So road taxes, stamping duty and road taxes, so municipal taxes, these are all not subsumed under purview of GST. So the above all, majority of the indirect tax which was levied before 1/7/2017 are subsumed under purview of GST, but only some taxes are not subsumed. Some taxes are not subsumed. So don't say all taxes subsumed under GST. We have to say majority of the taxes subsumed under purview of GST. Only few taxes are not subsumed. Few taxes are not subsumed. Clear? And before that, so first of all, why the previous indirect taxes are subsumed? And what is the reason? What are the need for implementation of GST in India? What is the need for implementation of GST in India? So, need for need for GST in India. So why the GST was implemented in India? Why the GST was implemented in India? The coming to the first one. So here VAT and service tax are not adjustable. VAT and service tax are not adjustable. So because, for example, coming to the food industry, so you go to the restaurant and you purchase the food. For example, you purchase the biryani. So cost of the food is 350. Cost of the food is 350. On that product they impose what? VAT. For example, 10%, 35, 385 rupees there. Again they levy what? Service tax at 10%, 38.5 is there. So 443.5. So if you observe here, VAT paid on the respected product, VAT paid on the respected product cannot be adjusted against the service tax. Cannot be adjusted against the service tax. Only the reason is VAT is levied by state government and service tax is levied by central government. So remember one thing, to set off or to adjustment of two taxes, both taxes should belong to same government, either central government or state government. So in case of food, what happened? So they purchase the, for example, coming to the biryani, they purchase the rice and they purchase the masala items, they purchase the chicken. So these are all covered under the definition of a good. So those are liable for VAT. Then coming to the another part, so those are prepared, the biryani prepared are made by the chef. He provide what? Service. And one party so came to you and took the order. So that is covered under service. And one party deliver the product to you, that is covered under service. After completion of the eating, then another party will claim the total level, that is said to be a service, and you use the premises of the restaurant, then you have to pay what? Rent, that is said to be a service, and you have the ACs and that is said to be a service. So these are all covered under definition of the services. So here the value of food is a combination of good as well as a combination of services. On the good they need to pay VAT, on the services we need to pay what? Service tax. But here VAT imposed on 350 and service tax imposed on 385, which is inclusive of what? VAT. And here what? So here the service tax imposed on what? Cost as well as VAT. Cost as well as VAT. So VAT is a tax which is paid to state government. Service tax is a tax, means tax imposed on tax, due to that the price of the product is increased. Due to that the price of the product is increased. So here VAT and service tax are not adjustable to one and another, because VAT is belongs to state government, service tax belongs to central government. And another one. Another one. There is, so here, Senvat credit is not available after manufacturing stage. Senvat credit is not available after manufacturing stage. If you observe, so if you observe the trade cycle, manufacturer to distributor, distributor to wholesaler, wholesaler to retailer, retailer to the ultimate consumer. So here for eliminating the cascading effect, what is meant by cascading effect? Cascading effect is nothing but what? Increase in the price of the product due to levying of tax at multiple number of times or imposing the tax on tax is said to be a what? Cascading effect. So for eliminating the cascading effect, previously one concept was introduced. In case of manufacturing and service, we call it as SENVAT. In case of VAT, we call it as what? Input tax credit. Input tax credit. But the problem is, if you observe the trade cycle, that SENVAT credit applies only to the extent of manufacturer. After manufacturer, that SENVAT credit is not extended. The seamless flow of the credit is not available. The credit is available only for manufacturer. Only for manufacturer, not for the other parties who involves in trade cycle like a distributor, wholesaler, retailer. So those are not eligible for claiming what? SENVAT. And third one, as we said, there is no seamless flow of there is no seamless flow of credit is available. No seamless flow of credit is available. And another one, different taxes imposed on same value by showing different taxable event. Different taxes imposed on same value by showing different taxable event. So just imagine, for example, you go to the for example, if the previous example is considered, in this case, you purchase the food. You purchase the food. So here the total value of the food includes for 350 rupees. Total value of the food is 350. So in case of value of the food, two elements are there. One is good, another one is what? Service. So on the good, they impose what? VAT. By showing the one taxable event is nothing but trading of the good. On the service, they impose what? Service. And by showing the one taxable event is nothing but what? Provision of service. For example, you go to the party and you purchase the entry fee, you purchase the ticket for entering into the respected party. So ticket price is around 4,000 rupee. For example, in pub, ticket price is around 4,000 rupee. So actually in pub they supply the food. So they impose what? VAT or CST, and they supply food or drinks, etc. And they provide the dance floor, means entertainment tax is levied, and they provide the luxury services. So luxury tax is imposed, and on an average they provide the services because security is there and the supplying persons are there. So they provide what? Services. That's why impose the service tax. But these all are imposed on what? Entry fees only. So by showing trading of the good, VAT or CST imposed. By showing provision of services, service tax imposed. By showing provision of entertainment services, entertainment tax imposed. By showing the luxury activities, luxury tax is imposed. But these all taxes imposed on the same product by showing different taxable event. The due to that, the price of the product is increase. That increase in the price is said to be a taxable, cascading effect. That increase in the price is said to be a cascading effect. That is one of the major drawback in case of previous indirect tax. So for eliminating the cascading effect, we have cascade SENVAT credit in case of manufacturing and service tax. In case of VAT, we have input tax credit. Even though cascading effect is not eliminated, so here cascading effect is not eliminated when the product involving taxes levied by both central as well as state government. Already we discussed. So, for example, coming to the food, so here VAT cannot be adjusted against service tax and service tax cannot be adjusted against VAT because VAT is imposed by state government, service tax imposed by central government. And even in case of manufacturing of the product, for example, I have manufactured one product, the worth around 10,000. So as a manufacturer, I need to pay the excise duty. At the time of trading of the product, I need to pay what VAT or CST. But CST cannot be adjusted against excise duty. Excise duty cannot be adjusted against CST or VAT. Because VAT is levied by state government, excise duty is levied by central government. Central government. So that is the reason. And even some taxes are there which are administered by state government only. Then those cannot be adjusted because those are levied by central government. Nothing but what VAT, sorry, CST cannot be adjusted against VAT. CST cannot be adjusted against VAT. Okay. So in this way, there are a number of reasons are there. So which are relating to what drawbacks in the previous indirect tax. Drawbacks in previous indirect. For eliminating these all drawbacks, so new indirect tax regime was introduced in India with a slogan "One Nation, One Tax." That is called as what GST stands for what goods and service tax. So tax imposed on goods and services. This is the why GST was introduced in India. Okay. So this is the basic concept relating to the introduction of a GST. Okay. Then we will discuss the remaining in the next class. Okay.